What if I told you the crash might already have started? It sounds dramatic, I know. The markets look fine, right? The S&P 500 is up, the headlines are calm, and most investors still believe everything's under control. But beneath that surface, under the layer of optimism, under the green candles on your screen, something very different is happening. You see, every major market crash in history didn't begin with panic. It began with silence. It began when everyone was relaxed, confident, and certain that this time is different. The truth is, the warning signs rarely show up in front-page news. They hide deep inside the system, waiting to be noticed. In this video, we're going to uncover those hidden signals, the invisible cracks forming beneath this bull market, the data no one's paying attention to, but should. Because by the time the crash becomes obvious, it's already too late to prepare. Today, I'll show you how 5 invisible forces are quietly reshaping the market. Forces that could decide whether we're standing at the top of a new bubble or already sliding into a slow-motion collapse. My goal isn't to scare you. It's to help you see clearly, to think like the smart money, not the crowd. Because the truth is, every crash also creates opportunity, but only for those who understand what's really happening before the headlines catch up. Welcome to Mindset for Wealth, where financial clarity meets real-world investing wisdom. Here, we don't chase hype. We decode it. We don't predict the future. We prepare for it. So stay with me until the end of this video. You'll learn how to recognize the signs that others ignore, how to protect yourself when the noise gets loud, and how to see every market downturn not as a threat, but as a moment of transformation. If you're ready to think differently, hit subscribe, share this video, and join a community that believes financial freedom begins with understanding, not fear. Because maybe the crash isn't coming. Maybe it's already here. The market looks strong. The S&P 500 keeps climbing. The Nasdaq is near all-time highs, and financial networks are celebrating the unstoppable bull run. But if you take a closer look, if you strip away the headlines and focus on the numbers, you'll notice something unsettling. The foundation of this rally is alarmingly narrow. 7 companies. That's it. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, the so-called Magnificent Seven. They're carrying almost the entire market on their backs. Together, they now represent more than 30% of the S&P 500's total value. That means if these 7 giants sneeze, the entire market catches a cold. Meanwhile, beneath those top names, over half of the stocks in the index are actually flat or down for the year. The average investor isn't participating in this rally. They're just watching a handful of tech giants mask the weakness underneath.
How much for this shawl?
It's like looking at a skyscraper that shines beautifully from the outside, while cracks are spreading silently through its structure. Breadth, the measure of how many stocks are rising compared to how many are falling, has been shrinking for months. That's often the first quiet warning before a major correction. It's what we saw before the dot-com collapse in 2000 and again before the 2008 financial crisis. The top looked solid, right before it wasn't. When you hear people say, the market is fine, ask yourself, which market are they talking about? Because what most people see is the surface, a market that appears unstoppable. But professionals are watching the details. Falling small cap performance, declining volume on up days, and volatility spikes that appear out of nowhere. This isn't panic, it's pattern recognition. History doesn't repeat itself perfectly, but it does rhyme. And right now, the rhyme sounds uncomfortably familiar. Every bull market hides a secret. It's not about optimism or even growth, it's about leverage. The invisible fuel that makes everything go up faster until it doesn't. In 2021, margin debt, the money investors borrow to buy stocks, reached its highest level in US history. After a brief dip during the 2022 correction, it's climbing again. Quietly, steadily. And that's where the danger lies. Margin debt is like oxygen in a room full of candles. As long as prices rise, no one notices. But when the wind shifts, when stocks start to fall, that same oxygen becomes explosive. One forced liquidation triggers another, and before you realize it, a small dip turns into a free fall. We saw this in 2008 when leveraged funds collapsed under their own weight. We saw it again in 2020 when a wave of margin calls turned a market correction into a full-blown panic. And yet, Investors keep repeating the cycle because leverage feels like free money, until it isn't. The truth is, most people don't understand how much of the market's growth isn't organic. It's borrowed, fueled by credit, margin, and derivatives layered on top of one another like fragile glass. And when one piece shatters, the rest follows. Right now, financial institutions are quietly tightening lending standards. Brokerages are quietly raising margin requirements. These are subtle signs, invisible to the headlines, that professionals are preparing for turbulence. They know that the higher the leverage, the thinner the safety net. Here's the paradox. Leverage makes bull markets look stronger, but it makes downturns collapse faster. It amplifies confidence on the way up and fear on the way down. It's not the spark that starts the fire. It's the gasoline that makes it uncontrollable. So when you see a market that rises effortlessly, remember, nothing in finance moves effortlessly. Someone, somewhere is holding the risk. And when that risk gets too heavy, it doesn't just disappear. It shifts, and eventually it breaks. Every financial system runs on one thing: liquidity. The constant flow of money that fuels credit, investment, and confidence. When liquidity moves freely, markets thrive. But when it dries up, everything begins to tighten, quietly, almost invisibly at first. And right now, that tightening has already begun. The Federal Reserve has kept interest rates at levels we haven't seen in over 2 decades. On paper, it's a fight against inflation. But underneath, it's creating one of the sharpest liquidity crunches since 2008. Every additional rate hike doesn't just slow borrowing. It drains oxygen from the market's bloodstream. When money becomes expensive, fewer people borrow, fewer businesses expand, and fewer investors take risks. Credit cards cost more, mortgages climb, and corporate bonds lose demand. It's like a slow frost spreading through the financial landscape, silent but deadly to growth. Meanwhile, the Fed's balance sheet reduction, quantitative tightening, is quietly pulling trillions of dollars out of the system. Fewer dollars in circulation means less liquidity for stocks, for real estate, for everything that once felt unstoppable. You won't see it on the front page, but traders see it in their screens. Falling volume, thinner order books, and sudden price spikes that don't make sense. Liquidity is like gravity, invisible but inescapable. When it weakens, even the strongest markets lose stability. The scary part? Liquidity shocks often look harmless right before they spiral. Remember March 2020? It wasn't fear that broke the market. It was the evaporation of liquidity. Buyers disappeared. Prices fell into a vacuum. Today, we're seeing early symptoms again. Treasury yields are volatile. Short-term funding rates are spiking, and corporate debt issuance is slowing down. Each sign on its own seems small. Together, they whisper the same story. The system is tightening, and the cracks are spreading. Most investors won't notice until prices suddenly don't behave. But by then, the silent squeeze will have already done its work. Every market is built on 2 forces, numbers and emotions. And more often than not, it's the emotions that win. Right now, the numbers are warning, but the crowd doesn't want to hear it. They want to believe the rally will never end. They point to tech earnings, to record highs, to AI, to innovation, anything that confirms what they already feel. Safety, confidence, certainty. That's how denial begins. We've seen this before. Before the dot-com bubble burst in 2000, optimism was everywhere. Before the housing collapse in 2008, investors called it a soft landing. And before the pandemic crash in 2020, the narrative was the same. Markets are resilient. They always are, until they aren't. Psychology drives the invisible crash because it blinds people to risk. Retail investors keep buying the dip because it worked last time. Influencers tell them the Fed has their back. Media headlines echo the same comforting tone. It's a feedback loop, one that keeps fear out but also hides reality. Meanwhile, the smart money behaves differently. They don't talk about risk, they act on it. They quietly reduce exposure, trim positions, raise cash. They don't wait for panic, they prepare during euphoria. The difference isn't knowledge, it's discipline. Here's the irony. Every crash is powered by optimism, not fear. Fear comes after. It's optimism that inflates bubbles, optimism that pushes valuations beyond logic, and optimism that convinces everyone this time is different. The invisible crash begins the moment people stop questioning, when greed replaces curiosity. So ask yourself, when was the last time you felt afraid to miss out? That emotion, FOMO, isn't just harmless excitement. It's the psychological pressure that keeps the system inflated. In every market, emotions are the hidden leverage. And right now, they're stretched to their limit. The crash doesn't start when people panic. It starts when they stop thinking. Crashes rarely stay local. In a globalized economy, money moves faster than news, and fear moves even faster. What starts as a small tremor in one market can quickly ripple across continents. In 1997, it began in Thailand. In 2008, it started in US housing. In 2020, it spread through every market on Earth within days. History has taught us one thing. Contagion doesn't ask for permission, it just spreads. Right now, the cracks are appearing again, but in different places. The US dollar is stronger than it's been in decades. That sounds like good news, until you realize what it means for the rest of the world. A stronger dollar makes it harder for emerging economies to pay their debts, which are mostly denominated in dollars. When those economies struggle, their currencies fall, inflation spikes, and investors start pulling money out. This creates a chain reaction. Capital leaves emerging markets and flows into the US for safety, driving the dollar even higher and deepening the crisis elsewhere. It's a self-reinforcing spiral that slowly tightens the noose around global liquidity. Meanwhile, geopolitical tensions are heating up, trade disputes, supply chain fragmentation, and rising energy costs. Each headline might seem isolated, but together they form a pattern. A world more fragile, more interconnected, and more vulnerable to a sudden shock. In Europe, credit markets are tightening. In Asia, manufacturing data is slowing. In developing nations, food and energy inflation are still crippling consumers. The signals are scattered, but the direction is the same. Stress is building. This is how invisible crashes turn visible, not through a single event, but through accumulation. One economy falters, another reacts, and before long, sentiment shifts everywhere. Investors don't need to see a collapse to feel one. They just need uncertainty. And uncertainty right now is global. The dominoes are set. All it takes is the right push. So, what if the crash has already begun? Not the dramatic, headline-breaking collapse that everyone imagines, but the silent kind. The kind that starts quietly, in the background, while the crowd keeps cheering. It's uncomfortable to admit, but maybe that's exactly what we're living through right now. Not a crash that destroys everything, but one that's slowly rewriting the rules of this market. Prices still move, optimism still exists, but beneath it all, the system is shifting. Liquidity is tightening, leverage is unwinding, confidence is fading. And yet, that doesn't mean you should panic. Because a crash, visible or invisible, isn't the end of wealth. It's the reset button of capitalism. Every collapse in history has created something new. After 1929 came innovation and reform. After 2008 came fintech and a decade-long bull run. After 2020 came digital transformation at a scale no one imagined. The system doesn't die, it evolves. But only those who adapt evolve with it. That's the real mindset difference. Most investors react to the noise, headlines, fear, emotion. But the few who succeed think in cycles. They understand that pain is temporary and opportunity is permanent. So when the next crash becomes visible, when prices fall, when panic spreads, don't ask, why is this happening? Ask instead, what can I learn from this? What opportunity is being born right now? Because behind every crash, there's a story. And behind every recovery, there's a mindset. The mindset for wealth is about seeing clearly when others can't. It's about being rational when others panic. It's about understanding that the true value of knowledge isn't in prediction. It's in preparation. If you've made it this far, you already think differently. You're not watching this video to chase hype. You're here to understand what's really happening. That puts you ahead of 90% of the market. So here's your next step. Subscribe to Mindset for Wealth. Join a community that studies markets not through fear, but through logic. Because the more you understand how markets move, the less power fear has over you. When the next storm comes, and it always does, you'll be ready. You won't panic. You'll prepare. You'll act. And maybe one day, when everyone else sees the crash, you'll already be on the other side of it. Calm, confident, and building your future while others are still looking for the bottom. Because wealth isn't built in the calm, it's built in the storm. And that's exactly where clarity begins.